Welcome to Cambridge House Live. I'm Bridgitte Anderson and I'm joined by Frank Holmes, the CEO of U.S. Global Investors. Frank, it's nice to see you again.
Good to be back.
Let's talk about 2013 first, because you rode that wave of equities and you saw rewards of 30% plus. So tell me a little bit about what was driving that last year before we dive into what you see for this year.
Well, I think the U.S. economy started getting traction, and you had just this, people get so caught up with American politics rather than looking at it as a sporting event.
Yeah.
It really is. And the loyalty that we live in Texas, so we see in a business that the loyalty between the Texas Aggies and the University of Texas football rivalry is incredible, no matter how bad the team is. Mm-hmm. The loyalty. The same thing happens with Democrats and Republicans. It is a sporting event. And what they did do last year is they basically put a cap on spending. And they said, if you want to spend there, you have to take away from here. You cannot have this continuous spending. And then you have the fracking and oil and gas benefit of less imports because of less soldiers in the Middle East. And you had more supply. Well, guess what? The dollar gets stronger, current account looks better, and the economic engine of job creation starts to take hold.
So do you think that's just more momentum to build in 2014, or what do you see happening for this year?
At this stage I do, because the global PMIs, we like to comment, we've written about what's called Purchasing Manufacturers Index.
The PMI.
And we noticed the PMIs last May when the punch bowl was being pulled away of federal government spending, and particularly monetary spending by Bernanke, that the emerging markets collapsed, resources collapsed, gold sold way down. However, German PMI all of a sudden starts making new highs. The
Right.
French. That was a turning point to say that there's something happening globally. And now we've seen global PMIs turn positive since the summer, and that's always a precursor for demand for commodities and job creation. And all politicians only care about is job creation. This particular venue and conference is concerned about supply and demand of resources.
Right. Well, we'll get to that in a minute, but I want to keep talking about the global demand. So you see that that still is very strong and continuing right into 2014.
It's not robust like you had 2004 and 5 and
Right.
6, but it has turned the corner. There's still lots of supply capacity for jobs and job creation opportunities, and that's going to just be modest. So I think because of that, interest rates will stay modestly low for the G7 countries. They're not going to spike up dramatically. And that means they're going, because politicians want to be able to make sure they have some type of job creation.
So it sounds like you're pretty comfortable to stay in equities then. Are you doing anything to hedge your bets?
No, definitely be in equities. And when it comes to gold as an asset class, we always say only 10%.
10%.
And have 90% in blue chip stocks and rebalance. The magic is this greed DNA and this fear DNA takes over at the wrong time. So the idea of having 10% weighted in gold and rebalance each year gives you this discipline of not being overwhelmed with greed and fear.
What's your approach to bonds right now then?
Well, it's a great question, because since the 2008 crash, more investors put money into bonds that are only up 20%, and the stock market's up 120%. And gold is still up, I think in math, almost 50% from 2008. So you get all this negative rhetoric on gold, but in fact, bonds is where most of the money went, has been now down. So and a lot of wealthy investors listen to all the negative media and talking heads on this political battle that they missed the stock market's spectacular run. And if you went back 100 years of data in America, the best bull markets are a Democratic president and a Republican Congress.
So you're keeping an eye on the presidential election cycle as well then. You think that has a factor here?
And historically, the first 2 years are the most challenging, and the last two are the best for the stock market. Well, these last 2 years have been home runs. So what does it look like for the odds for the next 2 years? I think it still remains strong.
Okay, well, let's turn our eye a little bit towards some of the junior market then, because 2013 was yet another tough year. Do you see that changing for 2014?
I think that Canadian companies are going to have the benefit of more acquisitions because it's deemed as a safe country. There's been too much turmoil of governments moving the goalposts in Latin America and Africa to really be able to raise substantial amounts of capital to go into those countries.
Well, because that really was one of the things that I talked to a lot of people about in 2013 is just that lack of investment coming in. So do you see that there is a change on the horizon there?
I do, and a company's going to have already spent the money. because there's just so many regulations. The financial capital markets, cost of raising money for a company, selling a mutual fund, all this stuff has become so prohibitively expensive in this country, and that makes it even more expensive for the formation of capital model. Now you're seeing a wave in the US coming with crowdfunding as a way to attract money, because they found that more money was going to buy lottery tickets in casinos where you don't need a prospectus, but if you put $100 into the investment, you need a $250,000 prospectus. Well, you're starting to see that model change in the US. It's not here in Canada, but environmental costs, community costs, all this became so expensive, so that we believe that you're going to see a slowdown in the supply of commodities, but the world's going to continue to have babies.
Well, and there's still all the demand coming from the BRIC countries too, right? Which I think that sometimes people might overlook, but that demand continues to be strong.
And it's very significant. In the 70s, when the world only had 3 billion, not 7 billion people, the global footprint of China and India was 2% of the world's GDP. It's now 23, and it's growing. So I think it's very important for investors to recognize that bigger picture. And the other key factor is that in the 70s, they weren't connected. Facebook has 1.2 billion people connected with no passports.
I know, I mean, that kind of social community now is a big driver for
huge.
sure.
And then you have Google, and you have CNN, and you have BBC, these global news networks that are sharing information. And I thought the movie Slumdog Millionaire really showed that there's lots of hope even with despair in India. And I just came back from India, was with a group of CEOs for a convention, YPO group from all over the world, and WPO. And it was fantastic to see the change from the last time I was there in Bangalore, and the subway system is working beautifully, there's construction everywhere, so there is positive changes taking place, and there's 600 million people under the age of 25.
So
under 25.
Having been to India twice at least now and recently, do you see that there, talk to me a little bit more about the changes that you're seeing there. So obviously population, a huge factor.
I think that population is a big factor, but they're wired. You sent the best brains to Canada, to the US. They've gone back. There are now more FDA approved clinics for doing medical research in India than America. And they all have their PhDs from American schools and Canadian schools. So that connection, and what happens when they go back, they want this transparency of government. They want this accountability. They want the beautiful city of Vancouver, how the infrastructure here is just overwhelmingly spectacular. They want it because they've seen it and they've gone back.
Do you have a favorite metal that you are watching for 2014 that you think is really poised for some growth?
I think from just the metal point of view, platinum and palladium. China has sold over 20 million cars. The GDP of Africa is non-leveraged. There's no mortgages on, no car loans. There's no mortgages on homes. It was a cash trade, and they're still growing at 4%.
Lots of demand there.
Lots of demand. So with that, when you have cars, you need platinum and palladium. It's also used for jewelry. But 70% of the platinum comes from South Africa, which is unstable compared, and then palladium is from Russia. So the supply is easily restricted, but the world continues to want cars.
So obviously, Frank, you've got a bit of a global approach when it comes to your investing. But when you take a look at just maybe some of the other kind of indicators that you keep an eye on. So is it data or is it instinct? I mean, to me, it sounds like you've got a little bit of a merged approach on this.
Well, that's a great question, because knowledge, we believe, and we've written about this, comes from two factors: your explicit knowledge and your tacit knowledge. Now, the most simple metaphor to grasp that is getting your driver's license doesn't mean you're a good driver.
True.
So you need that tacit knowledge of how to back into back into a parking spot. Now you've become a good driver. You're moving to England. You're going to be doing broadcasting in London. You have to now do the explicit test all over. They have different signs, different meanings. And what happens when you drive on the opposite side of the road and it's manual? So you have to go through that tacit knowledge again. So as investors, we are big believers in having micro stock picking models, macro geopolitical models, and then going and visiting the countries. We have an analyst here that's going around visiting the booths and getting updated from get that feeling from the geologists and what they're saying about their companies.
So, given where we are then in the cycle and what you see happening globally, what advice do you think, or lessons learned, maybe that's a better way to put it, what lessons learned are there for some of the mining companies?
Do not have that gap model. That's growth at any price. That's a disaster. Growth at any price is just caused more problems. More CEOs in the gold space have lost their jobs, and chairmans, etc., because it was just for sake of growth, not growth in top line, reserves. No, you need profitable cash flow, because you will have downdrafts, you'll have these dips, and you become overextended. So I think there's going to be a huge contraction of that thought process, more so, and you're going to see companies like Cisco that went from $1 to $25 and fell to $3, and now take it over at $6. Well, all that, the political risk of Quebec is a lot less than Argentina.
Right.
The cultural understanding, common law is much better if you look around the world than the laws, civil law that they have in Argentina. And then you have a company that all the environmental rulemaking, all this stuff's been done, all the infrastructure's been spent, all the capital's been spent, and now it's much more accretive for Goldcorp. So I think you're going to see any gold mining companies in Canada which have a certain size and dimensions of grade and infrastructure already done, they're takeover candidates.
Okay, sounds like it's going to be another good year to watch. Thanks very much for your time today, Frank. I appreciate it.
It's great to be here.